So we're going to talk about 5 things you should know about your investment portfolio. For this example, we're going to look at VOO, which is the Vanguard S&P 500 Index Fund ETF. It's basically a fund that shows you what the general US stock market's doing, so I think it's a good fund to just use for evaluation. I'm using a tool called Morningstar, which you can actually use for free to get a bunch of data. I have a paid version that shows a lot more detail, but for today, let's just use the free version so you can see real life data that you can pull on your own. So the first thing we want to look at is something called general performance. Towards the top, you'll see that there's a star system. This fund, VOO, has 4 stars. Morningstar has a ranking system that ranks things from 1 to 5 stars. 5 is an A++, fantastic rating. 1, not so good. Honestly, pretty bad. And the way they do that rating is based off of the risk to reward relationship for that particular investment. So generally speaking, anytime you see 3 stars or more, that's okay. You don't need to worry too much. But if you're seeing 1 or 2 stars, you probably need to reevaluate and see if that fund or that portfolio is really doing the best thing for you. Next, we'll talk about fees. Here we have the same screenshot, but we've outlined where there's something called expense ratio, which speaks to the cost of investing in this fund. Vanguard is famous for having really low cost funds. Nowadays, there's a ton of other options with really low expenses. And this is an important part of investing because if you're going to get the same type of investment, you might as well pay the lowest fees you possibly can. So expense ratio or expense level is really important to identify. Fees can range from 3% down to almost 0. So here the fee is 0.03%, so 0.03 of 1%, really low cost, and that's a good thing for your investment portfolio. Next, we'll look at actual performance. So this is how the portfolio or investment actually did over some course of time. The first thing we'll show you is a screenshot of the 10-year return for this fund. And you'll see a bunch of squiggly lines. It compares this fund to others in its category and then also an index. And the index is basically how the average fund should have done if it used an indexing strategy, which is basically a passive way to invest where you just buy up everything and kind of let it roll. So Vanguard's fund that we're using is really an index fund at the end of the day. So that's why those blue and red lines tend to move so close together. So again, actual performance shows you how it's really done. Next, we'll see the year-by-year returns. And we've circled in green the 10-year returns. That's the one line you really need to pay attention to. And it's showing you from 2014 to 2023 how the fund's done year by year by year. So for example, in 2019, there was a positive 31% return. In 2022, there was a negative 18% return. 2023, there was a positive 26% return, and then year to date in 2024, this fund's up almost 12%, so 11.78. We can take the performance one step further, and we can look at 1 year, 3 years, 5 years, 10 years, etc. I like to look at longer time frames because that gives you a better barometer of how something really performs over time. So again, with this fund, over 10 years, the average return is close to 13%. So 12.98. So if I'm going to compare this fund to something else, I don't want to just look at how it's doing year to date. I also want to look at the 1, the 3, the 5, the 10-year comparison, maybe even more time frames if necessary. Fourth, let's take a look at risk. There's a lot of ways to evaluate risk. I will admit Morningstar's done a great job of updating the data they show us. So now to the left side, you'll see there's a dial from 0 to 100. And they rank this as a 72 for risk. And according to them, that's aggressive because it falls within their range of 48 to 78. Now in the middle column, you'll see the risk versus category is average, which makes sense because it's an index fund. But if you look at the return versus category, this fund has done above average. So that's something we like to see. Whenever we invest, we want at least to perform average, so to at least be on par with everyone else. But ideally, we want a little bit better than average. We want as much as possible, but realistically, if we can even modestly beat the averages, we're going to be on a great path for success. Now, we have circled and highlighted one thing called standard deviation. Standard deviation is basically a statistic that tells you how much an investment bumps up and down, above and below the average return over time. So think of standard deviation like speed. If you're in a car and you're going 15 miles an hour and you run into a pole, you're probably going to be hurt, and that's a way we can compare how your portfolio performs. So now let's say you're in that car and it's going 25 miles an hour. If you hit that same pole, you're probably going to be hurt more than when you were in the car going 15 miles an hour. So that's how standard deviation pertains to investments. The higher the standard deviation, the bigger your losses will likely be when the market goes down. And then typically, the higher your gains will be when the market goes up. So again, I know that's probably a bad example, but standard deviation is really the speed of which your portfolio varies from the average return that you see historically. Finally, number 5 is to talk about portfolio composition or holdings. So if we start from the top level, we can see here that this will show us, do we have equities or stocks? Do we have international, US? Are there bonds, fixed income, other things? So that's on the left side. Then there's also something called the style matrix or the stock style graph. And that tells us if our stocks are large companies, medium, small, if they're value companies, growth, if they're blend, which is having some of both. This can vary drastically from fund to fund, investment to investment. So just important to know, are your investments in large companies, medium, small? Are they value focused? Are they technology or growth focused? Those little factors make some meaningful impacts on your investments long term. One of the cool things that you can also see in Morningstar is if you dig a little bit deeper, you can see exactly what you're invested in. So this VOO, Vanguard S&P 500 fund, has 504 equity holdings. That means they own 504 little pieces of stock in the portfolio. This screenshot shows you the top 10 of what's in that portfolio. So if you own this fund, you directly own Microsoft, Apple, Nvidia, Amazon, Google, Facebook, etc., etc. Now, unless you have a paid subscription, you probably won't see the full list of all 504 holdings. But again, as you assess your portfolio, it's pretty cool to know, hey, I'm invested in Coca-Cola, and Walmart, and Costco, etc., etc. This can also be important because sometimes people don't want to invest in certain companies. So by being able to understand what's in your portfolio, you can then sometimes avoid certain companies or make tilts and adjustments that are tailored to your needs and goals. So all in all, understanding your investment portfolio is important for long-term growth, but this is only 5 factors to consider. I would say there are many, many more things to know about. Additionally, this is a look at one individual holding where ideally you're going to have several holdings, especially as your portfolio grows. So it's important to know how each part of your portfolio works, but then also to understand how they all play together in the grand scheme of things. Again, this was 5 things you should know about your investments. I hope you enjoyed. Remember to like, comment, subscribe, and I will see you next time.